Welcome, ladies and gentlemen, to the Tactical Brief, to another issue of the Grey Market Talk with a retired market maker whose beard is growing back. We know now it takes 17 days to look respectable again, if you like beards. And with Nick Themistocles, former, bond trader extraordinaire, market maker for bonds, and the stuff I obviously brag about, my relationship to Nick, Chief Investment Officer, who had more assets under management than I could possibly fathom. If you can't handle the truth, 80 billion and more. Nick, thank you very much for joining me again.
No, it's good to talk to you again.
I really enjoy our little Sundays, and we're trying to get more entertaining and more valuable than ever before. And while I was preparing the sheets today, I went through the old sheets. We had quite a lot of very good hits, if it's even self-bragging here about the stuff going on. I didn't fit it in the chart today, maybe as a preliminary. I looked at the yen again, and when the Japanese introduced their, we called it ninja yield curve control, we were saying, yes, people are going to test how far they can go into the new corridor. And we are now at new highs again, aren't we?
70 basis points.
Yeah. So when do you think the ninjas will get their shuriken out and start poking holes into the speculators?
Well, that's an interesting thing, because we've also now got a situation where oil is really expensive for the Japanese, who are going to be importing this stuff, and that's quite difficult for them with a weak currency. But we know last week Ueda had said that he's actually going to most likely raise rates by the end of the year if inflation and all of the numbers and stuff like this. So, and I actually think that's quite feasible, and that may well turn things around for the Japanese currency and the markets actually to get this thing out of the way.
Yeah, well, oil is a critical issue for the Japanese. They started a Second World War over it, didn't they?
Well, I mean, if you think about what happened in 2022, when the dollar was really strong, who did it hurt? It hurt the Japanese. It hurt the Europeans, Germans mainly. Dollar strong, oil strong. It's a double whammy. You got trade deficits suddenly for countries that were very good at exporting, and that was not a good thing for these guys, and therefore, there was a lot of intervention. Yellen had to sort of knock the dollar down. We saw the dollar fall from 115. It's not, as I said before in many of these talks, the strong dollar is just not good. And a strong dollar and a strong oil is worse for the Europeans and for the Japanese.
Yeah, I have an interesting slide to the oil prices in there later, which I wanted to talk to you about anyway. Yes, we are both not oil experts, but the implications on the markets are actually quite interesting, quite funny. Anyway, so we started with Japan, even though it wasn't planned. I'm pretty sure we'll come back to it later. Let me try to share my screen, and you tell me when you see the presentation. Are we live?
Yes, we are.
Lovely. Grey Market Talk on the 17th of September, 2023. And today we have, obviously, thoughts from abroad, where I'm going to, tell you a little bit what's going on in Germany. Then Jesse Felder, former colleague, Bear Stearns, coined that. He said, we seem to have disinflation, but it's a transitory. I like that. Transitory disinflation. So I'll discuss that. And then sentiment and volatility. I will look into volatility again and do a shameless plug about my new website and articles you can download. I wrote something about that. I'll come to that then later. Let's start with the thoughts from abroad, where Nick, who is living in Germany and England, in Germany for a while now, will probably see what's going on. Everybody loved that slide. That was the PPI worldwide we have seen. And I got another one, which went more and more into the details on a monthly basis. And what you see here in the yellow box is actually the deterioration in the Eurozone. Interestingly enough, the United Kingdom, which was slammed for having left the European Union, was rated as being the worst of all economies, especially in the downturn. Now, numbers came out, GDP and employment figures. It looked as if the United Kingdom, that's my question to you, Nick, they did rather better than the Eurozone, didn't they?
In what you mean, they did less bad? Is that what you're saying?
Yeah. Okay. They were the cleanest shirt in the dirt hamper.
On this point on UK, and I actually think they will do better because they are unshackled from the euro. But clearly, when politics get in the way of what's good for the country, this is what happens. And there is doesn't look like there's a plan for the future. And at least if there is, they're not telling anyone about what it is. We'll have to see. Elections next year. This is not a good run up for the incumbents, for the Tories. They're not going to do well.
I was about to say, I think we mentioned that last week. Birmingham Council declared bankruptcy, second largest city in the UK. I found out they actually were run for years by Conservative Council. Wow.
All I can say is that I've been a supporter of the Conservatives for an awful long time, but I must say in the last few years they have they've not done well for the economy. And as I say, focus on post-Brexit is where they need to be, but they seem to be caught up in all sorts of scandals and this, that, and the other, and bad press, and they don't seem to have a good good standing right now. And the economy is obviously suffering as well. And when you look at the green areas of your chart, and look at who is doing well. Well, in Europe, it's Greece. Well done.
Yeah, well, with all of our money. Sorry, Nick. What I was focusing on was actually the topic, because we saw Rishi Sunak, Prime Minister of the UK, in India the other week, and just look at the PPI in India. And one analysis, a political analyst in the UK said to me, well, I think it looks like recolonization. The British economy is not what it used to be. And the clever boys are realizing, I better suck up to the Indians. That might be more beneficial to my economy than the other way around. And I thought, yeah, there's actually a point. We raised that as well, yeah?
Absolutely.
They just landed on the moon. The economy is growing. The PPI shows they are doing investments in infrastructure and everything. The mood is different. And pretty much every good company in the world is run by somebody with Indian heritage, who obviously inherited the work ethics and the intelligence to run these companies. So a model for the future now being proven, well, not just now, but is quite obvious in the data, what we're seeing here. The others are everybody who's heavy on oil. Saudi Arabia, United Arab Emirates, India we already mentioned. And what else can we see down here? China, Japan, they're not doing too bad here. Anyway, but we see our favorite candidate for the Thoughts for Abroad, Germany, being in a right pickle. And I have a couple of slides, and they're mostly funny, but I will lead to a point, because the first elections start now in October here in Hessen and Bavaria. And that has some implications, because the political system we see at the moment is shifting. Here, again, just to remind us, the growth rates of the G20 states, right at the bottom, if you can't see it, it's Germany with minus 0.2%, which I think is an utter lie. It's probably far worse than the numbers we can see here. And look again, who's at the top? My favorite. Exactly, my favorite nation on the planet, India. They're doing stuff right. And obviously, I was born in the year they landed on the moon, and allegedly to my parents, or to my mother, I was in front of the television. And I was only 3 months old, but I was in front of the television seeing that. I'm always, call me an old fogey, I'm always impressed if a nation goes that extra step. Does it bring any economic benefits in the short run? No, but we're doing something. We're brave, we are creative, we see no limits, and that has a huge implication, I think, for the whole society we see there. So yes, India clearly on my radar. And I found this quite interesting. It's a bit small, but I was focusing mostly on consumption, weak GDP and consumption. So red is weak GDP and green is strong consumption. Guess where Germany is? Weak GDP, weak consumption, and the DAX is still at levels where everybody is screaming for an all-time high. Yeah, riddle me this, Sherlock. I just thought it's very revealing. And but we are, well, in this we are last again. It's a slide. It shows the digitalization in the European Union, and the red is not number one. It's place 27. This is Germany. So if you want to set up your little internet company or something interesting which relies on high bandwidth and fast connectivity, you better do not do that in Germany. It's on place 27. So with all these billions we spend over the years, we were not able to not just build up a state infrastructure, but also were not able to entice private industry to set up the structure with which they could make money. UK, if you go somewhere, even in, I don't know, in the North Dales of Yorkshire, you get fast internet. I've seen it. I've tried it. In Germany, you leave the major cities and you're suddenly in the dark. One bar on, what was the Model G? 3G? Something very, very slow. So yeah, very good. But always keep in mind, with every slide, I'm putting up DAX at almost all-time highs. Then we see here Germany's contribution. So we're the last again, which is quite interesting. Germany's contribution to CO2 emissions compared to China, the European Union, and my favorite country, India again. Nick, remind me, which were the countries who were doing best in the charts I showed up before?
Yes, indeed. Well, I think you're going to answer that question, I'm sure.
Yep. So I thought that, yeah, that is definitely something we should have on the radar. And what we are good in Germany is obviously new industries are building up in Germany. And there's a new company going to the public stock exchanges, and that is a company called Renk, and they are producing gearboxes for tanks. It's exactly what you want to see in Germany. A company going to the stock exchange because gearboxes for tanks, who, by the way, are not using electric batteries to operate because it's not really reliable, is making a reappearance at the stock exchange. Second time since 1923. So it's just one of these little anecdotes I like to sprinkle in to see where we are. On the other hand, Volkswagen is actually skipping their plans for a new factory for electric vehicles in their newest series called Trinity. And the funny thing is, actually, nobody ever think at these marketing agencies. Trinity was the place where the Americans blew up their first nuke. Yeah? And Volkswagen apparently seems to have problems. So they're skipping it, which means less. Maybe the German government will persuade them by giving them lots of subsidies. That's what we seem to do at the moment here. But when we are very good, we've introduced, especially in Berlin, a new, how would you call that? Almost official but non-official local authority. You haven't done anything legal, but people can report you if you issue an opinion other people do not like and you're being put into a register. Reminds me very much of the GDR time or of the Nazi time even before. So it's people can tell on other people about stuff which is at least not at the moment not illegal. So if you disagree with government policy on all sorts, you might get reported. It's actually scary. Especially when you see we're introducing tanks again, we can't do proper decisions in the industrial side. And obviously the Bild Zeitung, Germany's biggest tabloid, is banging on about electricity prices, which are rising in Germany again. And it looks, before we switched off our last 3 nuclear power plants, which produce 12 gigawatts, we are every day now at specific times our net importer as an industrial nation. Of these, funny enough, around 12 gigawatts. So the wind and energy is not there to give reliable consumption for everybody. You can measure that at home actually quite nicely. Nick, you have an oven. We have 2, and there are oven clocks on there. And these oven clocks are not powered up by a normal battery or by the plug you put in the corner. They're directly to the heavy electricity part where your oven operates with, which is dependent on that you keep this 50 hertz frequency going. Otherwise, you have a blackout. So the moment you edge below that 49 point something, you have less energy, so the oven clocks are going slower. Since we switched off, and I'm not making this up, I've taken pictures of that every 1 or 2 weeks because I'm a geek. I'm losing 2 to 3 minutes now over a 2-week period. So we must be edging at this below 50 hertz all the time in the German grid. And that coincided, this delay in time, with us switching off the nuclear power plant. So obviously there seem to be difficulties. The moment you don't have the crucial supply in energy until you buy the nuclear power now from France, there must be some delays, and you can actually see that on your oven clocks, interesting enough. But we come up with new ideas in North Rhine-Westphalia, which is run by the CDU, the Christian, the Conservatives, and the Greens. They want to introduce, and I'm not making this up, a new tax on sand, which you need to build solar panels to reduce the wastage of sand, I think, or just to get more money out of it. So you couldn't make these things up. That's why I like to bring them up. And leading to the point, there was a big scandal in Germany going on, because the Christian Democratic Union at CDU, the Conservatives in Thuringia, wanted to reduce the stamp duty if you buy a property from 6.5% to 5%. So if you think, okay, that is a lot of money, you buy an average house for 300,000 euros, that gives you substantially more money in the pocket. So they introduced that into parliament. And the special situation in Thuringia is you don't have one or two parties have the absolute majority. They rule in a minority system. CDU is officially the opposition, so is the AfD, the so-called Nazis in Germany. So the CDU introduced the tax reduction, and the AfD and the liberals, who are also in the opposition, agreed. So they had a majority suddenly, which everybody said, no, you can never, ever, ever even vote for the thing or be voted by if the AfD, the new Nazis, are voting for the same. And which is actually quite interesting. They always, the CDU always, and we never work with them together. Even if they want the same, we bring in our own submissions into parliament. This time, they brought in their own submissions, and the AfD said, yeah, reducing taxes sounds like a hoot. So did the liberals. And why did they do that? And now I'm coming to, yes, there are elections in Hessen and in Bavaria. And the traditional parties, especially the opposition parties, have noticed that they suck the big one. People, even if they're not happy with what our government is doing, still didn't want to vote for the traditional conservative opposition, the CDU. So now what they're actually signaling is, we've heard, yeah, you want less taxes, you want this, that, and the other. And it's introduced. They wouldn't have done it if there wouldn't be election next month in Hessen and in Bavaria. And if you look at this survey we have here, that's the latest election poll we had. On the left side, they show the AfD, they show the liberals, and they show the CDU. And on the right side, there is the so-called Freie Wähler. That's 3%. They're also usually on the conservative side. Yes, the FDP is in government, but they used to be conservative. They used to be real liberals. They believed in citizens' rights. So what you can see here, there is a clear conservative majority in Germany. Yeah? Obviously, nobody wants to ever play with the AfD, but the majority of German people seem to be shifting their allegiances. Yes, you will always have the 15% green voters, and they will never change. But the SPD, the Social Democrats, are losing a lot of their normal people who work hard. I think your party is not doing anything for me. And this is what we are seeing at the moment. There might be a policy shift coming to the, well, more conservative side, because how long can a government do what they're doing at the moment? If you see what's going on, there was you've heard about that as well, your property owner in Germany, this new renewable energy law, which is telling people that they have to introduce a heat pump in the heating system. Starting from next year on, you're not allowed to have a gas heating system anymore. And this will cost 3 trillion over the next 10 years, a huge amount. And it will save for 10 years the amount of CO2 China is blowing out in, guess what, how many years, Nick? So over 10 years, we save...
It's got to be 3 figures at least.
Yeah. So in Germany, if we introduce that, we save for 10 years with this huge amount we're spending on it, as much carbon dioxide emissions than the Chinese, drum roll please, blow out of their chimneys in 1 day. In 1 day. In 1 day. And we spend 3 trillion over the next 10 years to establish that. So the state's not spending it, it makes their people pay for it. Yeah. What does that tell us? Obviously, we are insane, yeah, but we knew that already. It also means inflation will still be a big topic here. And yeah, maybe sprinkle you in. That is the nice transition I want to make to our main topic of the day after I've got the excuse me, after I got the bullying out. Is this inflation we seem to have seen in the United States and also a little bit in Europe, is it transitory, or is it going further away? And we've seen figures last week, obviously, and we've heard ECB introduce raising their target rates, and we're waiting next week for the Fed to do their last 25 basis points hike. Nick, is that possible?
They probably won't. I think there's only a 3% probability of them doing something, and in fact, they shouldn't do anything. But that's a different story. But the market doesn't assume these guys will do anything next week. And the meeting after that in November, I think there's a 40+% probability of them doing something. They may well do something, they may not. But you could probably expect that all of these central banks have reached the level where in this game of chicken that they're playing with the markets, that they're going to press the pause button.
So real rates, we are at the moment just around 2%, right?
Real rates, yeah, in the US.
In the United States. And when I looked at the inflation figures or the disinflation figures or whatever you want to call them, what I find always interesting, I was banging on about that in the past, the core rate. Yeah, let's take out what people really need, food and energy, and then claim we've just taken that out because it's so volatile and it doesn't influence our policy decisions. Complete and utter madness, I think. And what we've seen here now is airfare has gone down, rental cars have gone down, used vehicles have gone down, furniture has gone down. And what we see on the upside, overall inflation, 3.7%. Pets and pet products have gone up, and rent building is one of the big topics we have. And I've prepared a couple of slides where I look at the housing markets, and there is one thing I hope you can explain to me, Nick, because I haven't really understood it. What's happening there? Oh yeah, let's quick that in because we had that in the intro. Strategic Petroleum Reserve is at a low, and we were trading at above $90 at the moment, right?
Yeah, that's correct.
What's the implication if I look at a chart and say, yes, they actually managed to halve the Strategic Petroleum Reserve from June 2020 on, and now oil prices are at 20. And if I remember correctly, Biden said he wanted to build up the reserve again when oil was trading below $80 or something.
No, it was $70. I thought I heard him. I thought the quote was, so and oil did get down to that level. And I just think he was, I don't know, greedy or whatever, or his advisors were. But yeah, we're back to levels in oil where already, the reason that oil started to fall was because of supply, and the supply that was predominantly coming from the States, and I'm sure a little bit OPEC. But, those factors are gone now. Now you've got a situation where OPEC have restricted supply, where the Americans, haven't got anything in the tank to, throw into the market anymore to get the price down. So oil is now free to, move properly, if you like, across the demand, and we'll see what the Americans do. I think I heard this is something like 46 days of supply of oil, which is not very strategic. Frankly, 46 days is neither here nor there. So they've got to do something. They're going to pay up. They're going to have to do a deal.
I think it would be interesting. I didn't come across that slide. Maybe it doesn't exist. I would like to see the Strategic Petroleum Reserve China has versus the United States and how that has developed. Because if I, again, remember correctly, I've heard that the Chinese are massively building up their strategic reserves at the moment.
And you can imagine, that's what strategic is all about.
Yeah.
If you're using your strategic just to cap the oil price for a year or so, if that's the trade, then people will just say, okay, well, we'll let you do that, and then when you finish, we'll drag the price up again. China are building up reserves of oil, reserves of grain. These guys are preparing for, they just want to make sure that there is going to be nothing that is going to stop this economy from moving forward, and whatever other plans they've got, they take this strategic idea very seriously.
So I would put a tick in the box now. This is clearly inflationary for the future. Yeah? We are at levels of $90 now, roughly, but taking all these issues into consideration, it's more risk to the upside inflationary than to the downside.
Yeah, I mean, but we must sort of always distinguish between what is price inflation, what is monetary inflation, because price inflation is transitory, and monetary inflation is a little bit, takes time to work its way out the system. But yeah, I mean, you can imagine that there are some factors which are playing to the upside of prices right now. Oil, energy is one of them. We got this auto workers strike in America, which is, raises fears of wage pressures, and that's also not good for how the central bank kind of thinks in their monetary policy. So people then start to speculate, well, bit of oil going up, bit of a wage pressure from some powerful workers, that spells higher rates in the States, and then you see a tick up in bond yields. But we can talk about that a little bit further. But it's interesting that the 2-year doesn't seem to go really very high.
Yeah, well, I want to put another tick in the box for disinflationary. A beautiful chart from Game of Trades. Really enjoy their program. Manufacturing activity is at recession levels, what we can see here. ISM manufacturing PMIs in the United States. So we are crossing the line where we would say, okay, there's a contribution to a disinflationary environment. We discussed that before. Why are the unemployment numbers not going up? People were hoarding employees because they were looking for qualified workers, and when everybody tells you, yes, what we see here, we get a soft landing or no landing at all, and it's all transitionary, you're not going to fire your staff. You put them on the payroll even if your order book is shrinking. What will happen, obviously we all know that, if it comes to a scenario which I'm predicting for a while now that we're going to see it, all these people will be laid off, and then the traditional economists will finally get what they always wanted. Oh yeah, if employment goes up, then we will get into a disinflationary environment, which not necessarily is the case. Yeah, stagflation is still the ugly word. Any thoughts on that, Nick?
This chart is, I noticed it's from June, and I think the next 2 bits of data were higher. So manufacturing has found looks like it's found a low. But the economy is service driven right now, and maybe the recession, if we had one, is behind us. But the economy is still reasonably strong, and charts like this, when I look at something like this, I'd say, prices, there's something low there. So next, it's more likely to go up after this. And actually, as I say, the next 2 readings did go up. On the unemployment side, well, this auto workers thing is actually quite an important thing, because Ford, who have been, hit by this problem, are having to lay off people. And they've just laid off, I think Friday, 600 people, because if people in one part of the factory aren't working, and they say, well, then what do we need the other people for right now anyway? So we'll lay them off, and then we'll rehire them when the strike's over, and to save a ton of money. But where does this lead? Yeah, so people are frightened about inflation. You say, well, okay, you're giving money. All you're doing is transferring money from the company to the workers. Yeah, so you're redistributing the money that would have probably gone to the shareholders is now gone to the workers, and I don't see anything other than a little bit of I mean, it is a big strike and it is a big action, but I see that more transitory than anything else because, there are other factors that are going to play for inflation. There's a big thing about artificial intelligence. There's a big move with robotics. And so it could well be that, when you add up the pluses and the minuses in all of this wage stuff over the next years, that maybe it's not all about the sort of the strength of the unions, and maybe the unions are going to be losing their strength over the coming years. And actually the pressure on wages is something that will decline over time. And maybe this thing is just like a transitory thing, a last hurrah for the company. And one other point on this thing, I mean, the car industry is getting absolutely hammered anyway. In America. So Ford is having the same kind of troubles as everyone else. And that is because China is just stealing the show.
It's we have this discussion in Germany at the same time as well, yeah? Or not just Germany, Europe, that the Chinese companies are still building combustion engines, and in Germany, in Europe, it's ruled out from 2035 on. So you are not allowed to introduce a new combustion engine car on the roads. Interesting enough, I heard that earlier on a German podcast, that Chinese developers, car manufacturers, are building something to the region of 18, 19 new factories in Europe for combustion engines, which they are planning to use then in every part of the world where they're doing it, while we are giving away the technology where we used to be once world leaders in there. Doesn't that actually point to the Americans are obviously not as stupid as we are, that American car manufacturers, if they are still in this game, as well as Japanese car manufacturers, because I haven't heard anything from their side that they're stopping to produce good cars and efficient engines, to say, fine, eventually, if we see deterioration in prices in the big US manufacturers, it's rather a point they are cheap by all measures we have at the moment to build up a position there.
Yeah, I actually think that's if what you say is true, I mean, that's a good thing for the Germans in a way. I mean, it's a bad thing because, strategically that shows how screwed up everything is, but it's a good thing because the skills that are in Germany at least are going to be used for some time longer.
Well, in Germany now we have the situation where old ex-bankers are making YouTube influencer videos. So the skill set seems to have slightly changed, what we can see here. I have now a 3 series of slides, which I wanted to ask you because I can't make an idea out of it. I'm quickly run through it. First of all, you see mortgage applications to buy a house. They seem to be at a lowest demand in 20 years. At a level of 2014, 2009. And the next slide shows a flat chart. Median sales prices of houses sold in the United States are at levels of 1970 and 2008, 2 recession years. That's where we find ourselves. And at the same time, real mortgage payment price index is at the highest level we have seen since 1990. Here. What implications, if I go through them again? First of all, people are not applying for mortgages. Well, the relationship is clear. Yeah? If you already have a house, you don't want to sell it at the moment because you lose your mortgage and you have to refinance at high levels. Second, medium home prices are now contracting at levels. I'm listening to the news all the time. They tell me housing prices are at absolute peaks. How do these charts get together, Nick?
I honestly don't know, and I can see the source of this thing again. Look, if you want to sell a bear case for the market, there are plenty of charts that you can show, and I think a lot of these charts are from those people who are trying to support the case for, they've been believing in a recession for a long time, and they've clearly been wrong. The end of the day, in all of this stuff. I looked at real estate in the early part of this year, not commercial real estate, the residential side. And it was clear for exactly what you say, that the holders of property are not selling. The people who have built some properties are obviously doing some deals to actually get the properties off their books. So the builders are doing all of that. And because there is very few properties on the market, of course, the demand for properties has therefore increased. And so the rental has gone up. So this whole raising interest rates in order to kind of quash demand, and punish the economy and get inflation out of the system is actually working backwards, because that's why shelter has gone up. It's because rates are up. If we didn't have this situation with interest rates, then rental would be lower and so on and so forth, and you'd have a normal functioning market. But my conclusion when I looked at this thing was there was more weight of evidence to say ignore all the noise, that there is a property cycle that is 18 years in length, and you can worry about property in 2027 next, and everything that happens between now and then is just noise. And don't be confused by it, because you are rightly showing charts and lines and things saying, if I look at this one, I've got to be bearish. If I look at this one, I don't know what to think about the market. But there is a cycle in property, and it seems to be fairly strong. And all I can say is that I'm not looking at residential real estate as being the driver right now for a turn in the economy to send this economy down. Certainly not in the States.
So if you want to put it in a box for implications on inflation, neutral, inflation up, inflation down.
Well, for me, inflation is about money supply, and everything else is just noise. And when Jesse Felder's comment, which is the thing that you began with here, is it transitory? Is disinflation transitory? And I'd say the disinflation has come because the money supply has collapsed. Yeah. So bank lending has come down and all of this stuff. So the broad measures of money, M2, M3, have been coming down. And on a rate of change basis, they are negative when you look at 3-month rate of change or 6-month rate of change. But there is still an awful lot of money in the system that was created in 2020 and 2021, and those are the drivers of inflation. And the only thing that I can see on the horizon that will put a floor to stop inflation becoming disinflation, because money supplies goes down, you would think, well, everything therefore gets reversed. The only thing I can see that puts a floor on inflation going forward is the huge, monumental budget deficits of the government that on a yearly basis, they are putting into the economy 2 trillion plus. And whilst interest rates are so high, you can add another 1.5 trillion of interest rate money, which is working its way into the economy. So there's a phenomenal amount of money that is being pumped into the system by the government, both in interest rate payments and in terms of their deficit, which will continue to sort of keep, as I say, a floor on inflation. But we just have to watch what the money supply is doing. It's falling, but there's clearly still an awful lot of money in the system, and that's why the economies are strong. And all of the recession callers have got it wrong, in my view.
No, I that is one of the points I think where my view coincides. I was thinking long about that. We have all these indicators, leading indicators, inverted yield curve, you name them, they're there. They're clearly asking for a recession to happen. Why didn't it happen yet? Well, I'm not the only one who was more on the recessionary camp. And I thought, well, if I fill up my car with super fuel, and press the accelerator, and the other car next to me does 100 and I go 200, and suddenly I run out of fuel, I still have a lot of length to go till I roll out eventually. And I think that is what we are seeing at the moment. The recession will come, but we are on this super fuel still in the system, which has to first work its way out of it. I think that is my best take, how to define that. There is another interesting slide where we see what are our fellow colleagues doing. Hedge fund returns by strategy. year to date as of August 2023. Nick, where would I find you in which camp?
Well, you can look at our website actually and see, we are somewhere above 7.5 or something like this on a yearly basis. But what is this for 2023 returns?
Year to date as of August 2023. And the chart gives us, well, sector strategies, global strategies, multi-strategy, and the doc is CTA, Commodity Trade Advisors, are not doing well at the moment. Global macro is down, minus 0.81%. In their credits are at 5.34. Long biased equity, funny enough, 9.17. That's all the guys who are loaded up on Apple, NVIDIA, Microsoft, you name it.
Yeah, we invest in global equities around the world, and so we have a basket of global equities. So we invest in fund managers who do their job, and they do it very well. Japan was our big call. South America was our big call, and there are certain sectors which are still struggling. Asia is still struggling right now, so that's holding everything back, I would say.
Because that was another nice chart. It actually shows you Lehman was talk of the town. Lehman went bust many years ago now in September in 2008. I remember that. I was already unemployed because Bear Stearns went bust a little bit earlier, which is interesting to observe this whole. Anyway, it shows since Lehman went bankrupt, the FTSE All-World World Index, excluding the United States, versus the performance of the S&P 500. I thought it's actually quite interesting. What investors can see here, the world hasn't done too much without the United States, but the United States in itself has been the investment of a lifetime, you might want to call it. Sure. Can that go on like this, or will we see finally India taking over the lead, Nick?
Well, I mean, this is a really interesting chart, actually. And I saw this chart. I think I saw it today when I was flicking through some LinkedIn comments. I think I saw this one. And if I'm not mistaken, because I recognize this sort of post-Lehman thing, there was the funniest comment that I saw on this thing. It basically said, oh, so Lehman's were holding back America. And when Lehman's when America basically took off. But obviously this is, the power of printing money, the power of the reserve currency, the power of being the economy that just says, you know what, if we need to invest, we will invest. We'll worry about the debt later. And clearly, there's been, the political decisions that have taken place, the economical political decisions that have taken place have clearly worked for the economy. But also, I would say, the bad political and economic decisions taken by everybody else has worked also against everybody else. So, there are opposing forces here. I think America have certainly done a lot of things right for themselves up until now. The question comes, is, in the famous last words, is this time different? And, what do you do now? Right now, growth, which is powering the S&P 500, so these tech stocks, the momentum is still behind them. So, you can see that until that turns, there's very little reason for this relationship to turn. However, on a longer term basis, you can imagine that these other economies around the world will pick up. But you have to, as I said before, I'm a trend and momentum guy, and at the moment the trend and momentum is in favor of growth stocks and the S&P. The rest of the world needs China, right? So Germany need China. China is down in the dumps, and you can't sell a car to a country if the country is struggling. But if the Chinese can at least hold the line, then there is hope for other economies. But it still doesn't take away what the Americans have done for themselves, and well done for them.
Well, I absolutely adore the Twitter comment. Can you imagine? Then let's just blow up Goldman, JP, and Morgan Stanley. You have Nirvana. Absolutely fascinating. I put a little chart in I also stumbled across. Somebody did the numbers game. Obviously, we love these charts, and secular bull and bear markets in the S&P 500 starting with $1 at each cycle. And the representation, the green lines are obviously the bull markets, and the black lines are the bear markets we have in here. And I like the present position. If you have invested right at the beginning of the secular bull market at the moment, I think your $1 would have turned into, what is that, Nick? Something like $6.
Yeah, looks about
the
right.
49, 80, 68 bull market would have turned it into $8. 20 to 29, surprisingly enough, is we left that already behind at the moment. And only the madness, which culminated in 2000, gave you a 17-fold return if you got it right. My take, we're building out a double top here. The economic data doesn't make sense. We will see a recession, and this actually underpinned nicely what I'm preaching all the time. But hey, I've been wrong before. So that is actually, well, a chart where I want you to tell me that I'm absolutely right. It actually says nothing. What we see here in front of us is unrealized gains and unrealized losses on securities at commercial banks and billion. I assume they talk about treasuries and stuff like that. Yeah? So we've they are underwater, yeah. But it doesn't matter as long as the Fed says yes, this stuff is worth 100. Whatever you're going to do with it. Or am I getting this wrong? Is there
kind of, yeah? It's kind of right. You know, when you know, we come back to the comment of Silicon Valley Bank fell apart around about the 10th of March. And that was really the high point in the 2-year yield. And since then, the ECB have raised rates by 150 basis points. The Fed have raised rates by 75 basis points. The 2-year is still where it is. So, you know, whatever way you look at it, you know, this is quite an important level where we are right now. And your picture on the losses, you know, they have this facility, this BTFP facility, which effectively allows these banks to take bonds which have fallen in price and go to the Fed and say, well, I bought this thing at 100, it's now worth 70. Can you lend me 100 on the back of this thing, which is currently priced at 70, because you and I both know that you're good for it. The Treasury will pay up the 100 when this thing matures, and the Fed say, yeah, we'll lend you 100 on the back of this thing. And that effectively has given the banks some breathing room. But the bigger problem for the banks, as you know, is all of the money that's kind of finally coming from the banks who are paying next to nothing in terms of interest on the deposits. And this money is now flying to money market funds, you know, so the banks are now having to compete for sources of funding, which previously funded their business and gave them a decent margin. And now they're going to have to, certainly some of the banks which are struggling right now, are going to have to compete for funding, and therefore they're going to have to reduce their margins. And we'll see whether or not one or two of them, you know, fall by the wayside or get taken over in this thing. But, you know, does this mean the banking crisis is still alive and kicking? Well, I would say at the moment, we're not really seeing it in the price action, and I'm a price action guy. So I think that, you know, the information's in the price. If there was a banking crisis, you'll see it in one or two stocks, certainly, but the indices themselves have behaved themselves reasonably well. And the fact, and I come back to this, the fact that the 2-year is still at this level, you know, basically, you know, when SVB went down, is, you know, by hook or by crook, you know, the authorities don't want to see it above this level. They're probably too frightened of triggering yet another, you know, another crisis somewhere.
I'm good. You agree with me. It's actually nothing to see here move along. It's one of these dooms charts people like to post. You mentioned that was Japan. You mentioned the ECB. I think after what we've seen last week, it's another kneecap for Europe, or especially Germany. We can say, how can they actually keep on increasing rates, allegedly being terrified of inflation, while how I started this little presentation, they see as well as I do what's going on in our economy. Does that make any sense?
Well, you know, they are if you think that the ECB and the US and the UK are all following one line, okay, and everything they say repeats everything the other central bank has said. So they are all acting in concert together. But the words of Madame Lagarde this week seem to suggest, and she used the word, we are at levels which are consistent with, and all of this stuff, basically implying that it's most likely that they're pressing the pause button to see. But notice that, you know, the Europeans have negative real rates still, okay, which is a good thing for an economy in debt to have. And the Americans have positive real rates, and therefore that's not necessarily very good for, or not sustainable for their current debt situation. So it could well be that the Europeans are saying, well, that's as far as we go. We've still got negative real rates. It should be sort of good for the economy. It should be, you know, good for, if you like, inflating away the debt of the governments. But the Americans are in a totally different state. But I think the Americans, certainly we know that they're going to pause next week, or at least the probability is down that route. You know, were the Europeans right to raise rates at 4%? Can the economy take rates at 3%? I thought they should stop rate rises much earlier than this. The economy is certainly not ready for high rates. It works totally different to how the American economy is working. And in this respect, I would say, well, you know, they better hope that, you know, they haven't pushed too hard, is all I can say.
I've had another bit of anecdotal information last week. A French high yield issuer, I forget the name, the equivalent of B&Q in France or OBI in Germany, actually had to call off their high yield issue. And people who know about this stuff say that doesn't happen very often. That investors simply say, no, not at these levels, mates. You go someplace else. And that went through my mind when I thought, okay, you're deteriorating the financial conditions as well for these companies who desperately need it. And well, I think it's kind of a big thing if you hear something like that.
Yeah, I think that's right, because as I say, bank lending is in decline. And you know, savings rate is fairly high in Europe, much higher than it is in America. But the bottom line is there are a lot of companies who aren't as well shielded, let's just say, as you know, maybe because they made the wrong decisions, maybe they held out for lower rates, and they should have done they should have launched their bond much earlier, and they come in at the wrong time. You know, I don't know. I mean, it's a combination of a number of things, but that's not a good sign, of course. It may just be a one-off, but I worry more about the European economy, because there's so much wrong with the European economy, and then on top of that, you know, you're raising rates to you know, 4% to the 4% level in such a short space of time, right? I mean, that's really the bigger thing is, you know, I think people can cope with things being done gradually, but suddenly and all at once, you 6 months later, you're at 4%. That's not a good sign, and it will affect a lot of people.
You know, the magnitude is a killer. So let me slowly shift over into the sentiment part of the corner, which is actually quite interesting. Sometimes I sit in front of the television, that's my television, I have to do a screenshot what I see in front of it. ARM Holdings begin trading, AI, new technology, SoftBank, fantastic, up by what, 17% at the screenshot. Nick, is something wrong in the market? Usually when you come with an AI new issue, it should be up 100%, 200%, 300%, not 17. That sucks.
I don't know. Maybe they priced it, you know, because there is, you know, a lot of fantasy. You know, maybe they priced it because of the fantasy. I honestly don't know, but I don't think that means that there's anything wrong. As I said before, I think, you know, the whole tech sector is still looks like it's got the momentum behind it, and therefore, for that reason, it's premature to raise any red flag that because we didn't sort of make 100% on day one that there's something wrong. I think that's premature, but let's watch this thing.
Let me tease you with another shot of my television. The trade on Charles Schwab, because you mentioned the banking crisis earlier.
Yes.
And is it over or not? Down 30%. Apparently, they have problems attracting money from investors.
Yeah, I think they are one of the sort of vulnerable candidates on sort of deposit funding and things like this. So that's problematic. Don't know where it goes. Don't have any insights on Schwab. Don't follow it. Don't do any analysis on it. Haven't seen analysis on it, other than they seem to be the most vulnerable in terms of deposit flight. Frankly, but that affects the business model.
Well, actually, nothing can go wrong because the super geniuses at the Fed of Atlanta, who forecasted GDP at 6%, have now reduced it. Apparently, they're supplying day traders with their data, as it looks like, and are now again below 5%, 4.9.
Yeah.
What's the value of these forecasts, Nick? Because we both know it's rubbish, right? What they're telling us here. Well, where are they collecting their data, and are we going into the region of China? Yeah, the growth is wherever we say it is.
Not quite. I don't. People can either follow the value of Atlanta Fed, and I follow them because I find that their work is solid. But obviously, it's like everything else. If you've got 10 bits of data in and you show it into your model, and your model says, oh, it's 6%. So you say, okay, it's 6%. And then so it's out there at 6%. And then 2 days later, you're going to get a number, which then you throw into your model and you say, oh, actually, it's 4.9. Perhaps what would be, more useful is to say, show a little bit more transparency on what data is still to come. And when the last bit of data was updated, and I'm sure they've got sort of, many things that sort of go into this model, but I still find it of use, because if we didn't have this, right, what else would people do? But they would have to do their own forecasting. And a lot of people who play things like the quad model, they don't sort of wait for the growth to come out or the inflation number to come out. They do their own nowcast forecasting. So every, quality institution with the resource capacity will do their own nowcasting, and they will be, playing forward where we are in that quad model, and saying, well, where are we heading right now? And therefore they start to position already for that. And, the Atlanta Fed is just, it's not a research institution, if you like, for the market, but we benefit from the up, and I think it's quite useful. The problem comes when I thought I saw something from Fred, the St. Louis thing, saying that their nowcast was 0. So I think that was a bit problematic, and I don't really know about how the Fred model is calculated. I think that's survey based, but I think it's useful, and I think everyone should understand that it's just a model and it's not full of the data yet, but it iterates its way to the right number. And whether it's 4.9%, and now we've got, an auto worker strike, we've got, things like the student loans going to be repaid, that will influence growth. So, you start with 4.9 and you probably think, well, okay, I'm glad someone's given me the starting point. Then I'll tag on student loans and an auto strike, and probably we end up at, let's just say 430 or 450 or something like that. And then I look at the 10-year yield and I say, yeah, it's about right.
I agree with you. Yeah, Bayesian probabilities make sense to update your model all the time. As advice, as a little bit of a math geek, I would simply say introduce cubic splines flattening in your model, smoothing it a little bit, because these jumps, I think, make it just ridiculous for me. And I'm going to tell you what's going to happen now, because that's the kind of chart I love. The key treasury curve inverts for record periods of time. You've seen these charts before. I'm employing them on volatility all the time. And it's again one of these things. Yes, we had fuel in the tank, and the engine is still running, or we still have momentum. It's still working out, but this looks to me like, wow, that's going to be inevitable, and the crisis we are going to get is quite severe. by all data, all historical data, when I play with these charts, always tell me when I have these long outliers, the other side looks just as brutal and as severe as the thing we were waiting for, and hasn't happened yet.
So you're waiting for me to either agree or disagree. I know I can see it.
Absolutely.
I can see you. And I'd say that I disagree with that for a number of reasons. And you know, this inversion, you know, for what it's worth, you know, we understand why we have an inversion. But I've said before that I think the Fed have been playing with fire, and like the ECB, I think they've over tightened screws, and they are doing more harm in their policy than good. And if they want to fight inflation, they're fighting the wrong thing. They're punishing the wrong people. And in the end, they are just adding to more money being printed because the interest rate bill for the government gets higher. So that's the short end of the curve. And also real interest rates at 2%, good luck with your debt. That can't last. That's, I would say, the reality of the situation. And when it comes down to, obviously, therefore, your conclusion is, therefore, this thing is going to fall apart because as a recession indicator, it's pretty good. I think there've only been 2 instances post-war, post-Second World War, when the inversion didn't lead to any recession. And you know, I've looked into this myself. But as I said to you before, this time is different. I'll say it loud now. You know, this time is really different because, you know, you're not allowed to have a recession, right? In the Western world is not allowed to have it. Just forget it. You have no chance. So if you are the politician in charge of the Fed or Bank of England or the ECB, you just say, we're not allowed to have a recession. And they'll say, well, why is that, sir or madam? And the answer is, well, we can't afford it because we need tax receipts, because we got debt, right? So we need tax receipts to continue to go up. And if you cause a recession, then tax receipts go down. And if tax receipts go down, then our deficit gets bigger. If our deficit gets bigger, people, you know, interest rates start to go up. And the economy goes into this sort of death spiral. So your mission, should you choose to accept it, is to kind of convince people that you're doing everything for inflation. But at the end of the day, when push comes to shove, you save the economy before anything else. And therefore, that's why I'd say it may look like all hell is going to break loose when you look at a chart like this, and your conclusion, I totally understand it. And all of these other analyst firms, you know, who come out with these recession calls, you can't do it anymore. Not at this level of GDP, debt to GDP, not for the Western world. That would be the problem, rather than the economy being the problem. The problem will be the sovereign debt crisis, which will will create much bigger problems for the world than anything before. So, you know, before the economy has hit that line, which you know, that magical recession line, there will be, you know, those guys will tear their shirt off with a great big S, and they'll come in there and they'll just slash interest rates, chuck money into the system and go back to where it was. And, you know, one last thing, I mean, we know that the Treasury need to borrow an inordinate amount of cash. And we know that the funding from overseas has been growing at a rate of, and I did the calculation recently, of something like 2.5% over the last 9 years or so, there or thereabouts. And yet the demand for funding for treasuries is going to be growing at somewhere between 4.5% and 6.5%. So the supply of treasuries is growing at that level. So even though China and Japan have been reducing, other countries have been increasing. Yeah. So, you know, don't mix that one up. So we know that it has to be funded.
I follow your explanation to a certain degree. Yes, what must not happen cannot happen, or the other way around. But that sounds pretty much what probably the Politburo in the Soviet Union said. Socialism must not fail, and then it failed anyway. It's just the longer we procrastinate with the severe correction, the bigger, and that is, well, one of the common places, the bigger and more ugly and more brutal it's going to get.
The reason I believe that the Fed and the ECB have gone all out on a push for inflation whilst risking the economy in the short term is that if they didn't and people saw inflation, you have the opposite effect. You have the effect that people will lose confidence in the currency, which creates this hyperinflation spiral. So I think rightly the central bankers have come in there and said, well, we need to make sure that confidence is held. And so we've got to go in there and raise some rates. But we know at the end of the day, we can't go too far with that either. They will reach that point, and I think the Europeans have certainly indicated they've reached the point. The Brits, I think, have reached the point, and I think the Fed are most likely to announce they've reached the point, and they're going to watch it and see, and kind of hope that the declines in money supply will keep a lid on inflation, and then they can say, okay, they won't say mission accomplished because it will be a while to get to the target, or they'll change the target.
Well, you're absolutely right. If I go to one of the charts, I'm pre-jumping a little bit. This one, the VIX, lowest level since January 22. We all know what then happened in March 2020, not 22, 2020. We traded below 13 on the weekend. And if the VIX is a measure for how concerned people are, not at all. There's nothing to see here. You don't have to worry. And let me go a slide back. This is one of our own little creations. We usually do. I draw your attention to September. It's from 1994 till 2022. It's a seasonality chart broken down by days. And we are now slipping in the second half of September into, well, a scenario where you don't really want to have risk assets, an extreme low volatility of below 13. Yes, we've seen a little spike again on Friday, but as when you look at volatility charts, there seems to be a mean reversion, and long-term average is at 19.62. That's roughly what my numbers predict to me as well. So we are at an extremely low level. So I think at the moment, this would be important to be loaded up at least partially into every portfolio. Get exposure to long volatility. Don't be short volatility. And that is one of the numbers on I think the Maverick of Wall Street. I did a screenshot, posted this. The S&P options volume by time to expiry. And I thought this chart was very interesting. I'm all leading up to make a shameless plug of my website in an article I wrote. What you can see here, what I draw your attention to is these are 0 days to expiration options, is now 43% of the overall market. How can I interpret that? Here at the long-term option volatility market, you always have roughly 10%. Yeah, these are real investors who have long-term ideas, and it doesn't change much. It's a special group we see out here in the market. Same is true for the green, 61 to 90 days. These are not short-term speculators. Where the market actually always dragged its liquidity from when volatility was needed is this segment, 7 to 30 days and 31 to 60 days, which came down from 50% now to just 19%. So it halved in value, what we can see here. The case I'm making in my article on my website is simply, by the way, which is live now, and I'm going to share that in a second, where you can actually download this article I wrote about this. Let's see whether the sharing works. Share new, where's new share? There we have it. Share. You can see me, Nick?
I can.
Yeah. So if you go into the edutainment section on the tacticalbrief.com, publications and research, what you will find here, if you click on options, is the article which I called quite fittingly 0 days to castration options. Bad things will happen eventually. You just click on more, and then you get the article. Thank you very much to Bilal Hafiz, founder of Macrohive, who liberated it from paywall prison, because that's usually behind the paywall. I wrote that in May as an analysis, what could possibly happen here. And I'm going to stop this sharing right now. When we go into the volatility market, as we see at the moment, people are, and most of the people don't even know what that is. On the short-term option side, they change trading volatility, Vega, the sensitivity to volatility, to gamma, right? So now 40% of the market is uploaded with gamma. What could possibly happen is if we see something unforeseen, a black swan, People on the short end, on the 0 days to expiration option, they get burned. And this will introduce huge momentum in either direction, to the upside, as we've seen a couple of times, as well as to the downside. Then the market will scramble and say, okay, I need now volatility. I need Vega to protect my position in the long run. But the market has halved of the suppliers out there. So they're suddenly not in this market. You don't change your trading strategy overnight. I've seen that many times before. People are shifting their business strategy. You produce umbrellas, and you're not changing overnight, then going back to sunscreen. It's not happening. And we are building up this situation now where all the gamblers are on the short end of the market. They're actually trading gammas without knowing it, what they're doing, because it's a nasty thing to be gamma short. At the same time, volatility in the VIX is at levels of 13. Taking that together, famous last words, with a lovely chart about the yield curve inversion, how long we've been in there. It's simply my point of view. Yes, if you get volatility at these extremely low levels, put a tail hedge on, for crying out loud. Put a lot of your money in 5% yielding short-term treasuries and sit for a while on the sideline to figure out, yes, has AI produced free energy for everybody and the world is going to be beautiful again? On the other side, why would you take this enormous risk for the end of the year? And that's where it comes in. If I think like that, I think a lot of clever guys out there who are managing other people's money also think, oh, well, do I really want to chase the last 3, 4, 5% in the S&P for the end of the year, or shall I call it a year? And that coincides nicely with the September seasonality, second half of September. That's my short-term analysis. I don't know where it will be going. I personally, obviously, love the situation to buy volatility at these levels, sell it a little bit higher, and play this scalping game at the moment. I think your analysis being more on the positive side. Yes, if you're right, bad things must not happen. Therefore, they will not happen. We could see a fantastic bonanza towards the end of the year, because sensible guys like myself are on the cautious side right now, Nick. Gamblers like you are being long in the trending stocks.
No, I do agree with one thing. I think the yields that you're getting in treasuries right now definitely a pause for thought for a lot of people. Whether it's the short end yield or the 10-year yield, the real yields right now are sort of enough to entice people out. And then, of course, you've got this supply situation which has to be funded somewhere, right? And if the Fed at the moment is not funding it, then, that money's got to come from normal investors. If it comes from normal investors, then they can't be investing in stocks, right? So they've only got sort of a certain amount of money unless they leverage it. So you can envisage a period of time where actually, the markets are very subdued, and it's the return of the bond market. And one thing I've mentioned it for the last 3 weeks now, I'm watching like a hawk, is this relationship between SPY and TLT, or the DAX versus the equivalent in Germany. And although the SPY versus TLT is still in favor of the SPY, one thing I noticed actually I looked at it on Friday, I think it was, that the momentum is actually starting to decline. So you've got this negative divergence. So you can imagine that, because this for me is going to be, a huge trade, because, bonds have not outperformed stocks in the last couple of years. And therefore, being there at the time when bonds do start to outperform is I think, really important. And, we need to get that kind of level. And before I was really bearish on bonds, but, we reached this zone, this 4.25, 4.5. And that's when I started to pay a little bit more attention. So, I think we are also at a point where it does become interesting. And as I say, on Friday, I saw a negative divergence which favors bonds versus stocks. And for that reason, we're getting even closer. And that does fit with your scenario of take a pause, put some money into kind of theoretically safe assets and buy some long dated protection. I think that's a reasonably sensible trade in my view.
I heard this, I think this morning when I was listening to a podcast while having breakfast. Somebody went through the effort and looked at bond markets, government bond markets, that a bond market with govies had 3 years of negative performance, happened only once before. Guess which year? 1700 something, Civil War.
So it is a 200 year. Well, and here we have it, right? I mean, you've had 3 years, is it, or 2 years, or 2.5 years, whatever the number is, of underperformance of bonds versus equities, and we understand that, but there comes a point when you think this, and the timing of this is really important. And that's if you think that the central banks are at that point where they're going to pause, then there'll be a lot of people out there saying, "Oh, I wonder if now's the time." And of course, the thing going against all of that is the trillion that almost trillion for Q4 that they've announced for 850 billion of new treasuries. So the money's got to come from somewhere. And if the Fed are doing QT and the Chinese and the Japanese are saying, nah, and it's not sort of bought by UK and European investors, then the money's got to come out of stock somewhere, right? I mean, it has to.
Well, they could get it from Germany by simply building all the heat pumps we are going to install for 3 trillion over the next 10 years. And that would boost earnings in the United States to an unbelievable degree.
I mean, without being funny, although I think it's a daft idea what they're coming up with, but, if maybe this is their way to growth, but how do they get the trillions? Who's going to fund the trillions? It's got to be government guarantees, isn't it? It's got to be somewhere they're going to put it in a Sondervermögen. You like that word?
No, they're going.
What?
They're going to take it out of our pockets, Nick.
No, they won't.
You simply make.
We don't have it.
You simply make a law and say you have to do that now. It's we had that topic, I think, a week or 2 weeks ago. Social cohesion. It's not going to look good.
Social cohesion comes at a time when you realize that the cake is as big as it's going to get. If you think the cake's as big as it's going to get, then you need to sort of rethink about, okay, who's got what? But if you also think you're at that point where the cake is as big as it's going to get, you're in real trouble, because when I look at your debt load and you say, oh, hang on a minute, you need a bigger cake, right? And when you need a bigger cake, you don't solve it by raising taxes from 43% to 47% or whatever the number is. That's just sort of playing around the edges. You need something substantial, trillions of investment, like the Americans did. Look at that chart, post-Lehman.
Yeah. Hey, let me have the final word today, because social cohesion, my recommendation is, look who went to the moon just recently. Do it like the Indians. Their social cohesion. They unite behind a goal and they get it going, and they went to the bloody moon. That's what you want to have, social cohesion.
Brilliant.
Nick, thank you very much. I hope we'll see next week what the Fed has done or has not done. My take is they're going another 25 basis points. Yours was, no, they're not going doing anything.
Agreed.
Right, so one of us will be bragging next week.
Look forward to it.
Thank you very much, Nick. See you soon.
Take care, Bye.
Bye.